Hi everyone, I'm doing an audio clip to explain part 2 of lesson 7 summary on sales return. Now in lesson 6, we talked about sales return allowances, and that is a contra revenue account. And now in lesson 7, under accounts receivable, we talk about allowance for sales return, which is a contra asset account against AR. Now what's the difference between the sales return covered in lesson 6 and 7? Now in lesson 6, we record sales return as and when a customer returns the goods to the entity. This is commonly done by entities whose sales return is not material. Now usually these companies or these entities do not have a sales return policy. Now for entities that do not have sales return policy, sales return should not be material under normal circumstances, as sales return could be deemed as an indication of customer satisfaction, product quality, and future profitability. Now, even for entities which do not have sales return policy, they will sometimes accept sales return out of goodwill to their major customers. So as a result, these sales returns are not material and significant to this entity, and therefore this entity can just record sales return as and when it happened. However, there are other entities, such as the retailers like Marks and Spencer. They have a goods return policy, and this goods return policy could be material. For example, 10% of the sales are returned. Now in Singapore, most of the goods return policy from the retailers are within 7 days. But in UK, for example, Marks and Spencer can have a 30 days goods return policy. So in this situation, this entity cannot record sales return as and when it occurs, or they would be overstating their revenue and profits. Now, this entity would then estimate their sales return and record the estimated sales return in the same financial period as they record the revenue. Just like the impairment loss on AR, so that their revenue is not overstated. Now, because this is an estimated sales return, and we are estimating the sales return and recording it before the actual sales return occur. Therefore, we got to park the figure in this contra asset account called allowance for sales return. This concept is similar to the allowance for impairment of AR, where we estimate the impairment loss on AR before the bad debt occur, before the write-off occur. Now, so online lesson 7 is covering this kind of sales return to estimate the sales return and record it, and then record it to the allowance account, and then after that, what do we do when the actual sales return come back? Okay, so there's a difference between lesson 7 and lesson 6 sales return. Now, note that under these goods return policies, the goods return are usually in its original packaging and therefore still in good condition. Therefore, we have to take these goods back to inventory. Now, many students has mistaken this as compliance to matching principle, just like the impairment loss on AR. But this is not compliance to matching principle. Impairment loss on AR is an expense, but sales return is a contra revenue. The purpose of doing this is not to overstate the sales revenue and profit. It is not about compliance to matching principle. Note that matching principle is matching expenses to the revenue and reporting all the expenses incurred to generate the revenue in the same period as the revenue is reported. Okay, so reporting the sales return, which is a contra revenue, in the same period as the sales revenue, is not about compliance to the matching principle. So don't be mistaken, don't confuse this with the impairment loss on AR. Now, I'm going to use this numeric example to illustrate the journal entry recording. There are more than one method of recording, just like the impairment loss on AR. You can have different method of recording. But the end effect to the income statement and balance sheet is the same, regardless of the method of recording. Now, let's look at this numeric example. In the first year of operation, the beginning balance of the allowance for sales returns account is 0. Sales revenues are reported during the first year operation is $1 million. Estimated sales return is 10%. COGS is estimated at 60% of sales revenue, and the actual sales return incurred during the year is $60,000. Now, we expect 10% of 1 million, which is 100,000 of sales return to come back, but the actual sales return come back is actually 60,000. In other words, at the end of first year, we expect a further 40,000 of sales return that's relating to the first year sales revenue to come back in second year. Now, this 40,000 is sitting in the as the ending balance of the allowance for sales return account. In the second year operation, the ending balance of the allowance for sales return account in year 1 becomes the beginning balance in year 2. So the beginning balance of the allowance for sales return is 40,000. Now the sales revenue reported in year 2 is 1.5 million. Estimated sales return is still 10%. COGS is still estimated at 60% of sales return. Now the actual sales return that come back during the second year is 100,000. This includes 35,000 of sales return relating to last year's sales. But remember, at the end of last year, we expected 40,000 to return, but in year 2, out of this 40,000, only 35,000 returned, which means that the remaining 5,000 will not be returned. Okay, based on the note here, it said that note that any outstanding sales return relating to last year's sales will not be returned. Now, out of 100,000, the remaining 65,000 of sales return that's returned will be related to second year sales revenue. Okay, now let's look at method 1 of recording. This method is in accordance to the online lesson 7. Now, under this method, as and when we report sales revenue, we will estimate the sales return and record the estimated sales return. You can imagine that we actually do this on a monthly basis. Okay, so the consolidated figure will be, if the revenue reported for year 1 is 1 million, the estimated sales return will be 10% of 1 million, which is $100,000. So we'll debit the sales return allowance, which is a contra revenue account, and then you'll credit the allowance for sales return, which is a contra asset account, with $100,000. Now, at the same time, we have to bring the COGS back to inventory. Now, the COGS is estimated at 60%. So 60% of 100,000 is 60,000. So we're going to bring it back to inventory. So we debit inventory and credit COGS with $60,000. During the first year, the actual sales return that can happen throughout the year, throughout the first year, is 60,000. Now, because this is a first year operation, so we know that this entire 60,000 of sales return is related to the year 1 revenue. Now, we have already estimated and recorded the estimated sales return. So when the actual sales return occur, we will credit AR and we will debit to the allowance for sales return account. Remember in lesson 6, we actually debited to the sales return allowance account. But because the first entry, we have already estimated and reported the sales return allowance figure. So right now, we will record the actual sales return against the allowance for sales return account without touching the contra revenue account anymore. Okay, so we'll debit the allowance for sales return and we'll credit AR 60,000. Now, you also notice that there's no need to bring COGS back to inventory because we already done that in the second entry. Now, at the end of year 1, okay, we will have a 40,000 ending balance in the allowance for sales return. The beginning balance of the allowance account is 0, and then we credit it with 100,000 with the first entry. Then we debit it with the third entry, 60,000. Therefore, we will have a credit ending balance of $40,000. Now, note that for year 1, the sales returns and allowances, the contra revenue figure reported in the income statement is the estimated sales return, 100,000. Okay, and this is the estimated sales return, what the company expects to get back. In the balance sheet, the contra asset account, the ending balance of the allowance for sales return account reported in the balance sheet is 40,000. This is the estimated sales return that the company expects to get back, but the customer has not returned yet. Let's look at year 2 journal entry. Now, we started off with year 2 with a beginning balance in the allowance for sales return, $40,000. Okay, now, so as per year 1, as and when we report revenue, so for example, on a monthly basis, we will then estimate the sales return allowance and then record it. So cumulatively, we will have 10% of the 1.5 million sales revenue estimated and recorded as sales return allowance. Okay, so we'll put to an entry, debit sales return allowance 150,000, credit allowance for sales return 150,000. Then we will estimate the 60% of the sales return as a COGS and reverse the COGS back to inventory. So we'll debit inventory and credit COGS 90,000. Now, in the second year, the actual sales return is 100,000. So when the actual sales return occur, we will debit against the allowance account, allowance for sales return, and then credit AR 100,000. Now, take note that out of this 100,000, 35,000 is relating to year 1 revenue. But at the end of year 1, we are still expecting 40,000 of sales return to return. But in year 2, only 35,000 out of 40,000 of sales return came back. So we have a balance of 5,000 of sales return, which we have estimated and reported in year 1 that will never come back. Okay, now sales return policy has a validity. So once the validity period is over, we will be sure that the estimated sales return that was reported earlier will not come back. So we need to reverse. Okay, we need to adjust the overall under estimates that we made the previous period. So over here we have a overestimate of 5,000 of sales return, and we're going to reverse it in year 2. Okay, this is the overestimate made in year 1. So we just need to reverse the entry. Okay, we will debit allowance for sales return and credit sales return allowance 5,000, and then we will also reverse the COGS portion, which is 60% of 5,000, $3,000. We will put it back to COGS. So we debit COGS and we'll credit inventory. Okay, you notice that the last 2 entry is the reversal of the how we record the estimated sales return entries. Now at the end of year 2, the balance in the allowance account, all right, would be the beginning balance of 40,000 plus the 150,000 made. So 40 plus 150 is 190. Then we will less 100,000. Okay, that will give us 90,000. And then we will less the adjustment of 5,000. So we should have an ending balance of 95,000. Oh, sorry, 85,000. We will have an ending balance in the allowance for sales return of 85,000 at the end of year 2. Now, so in year 2, the sales return allowance reported in the income statement is 145,000. This is the 150,000 estimated sales return for year 2 minus the overestimate of 5,000. Okay, that's how you get 145,000. The ending balance allowance for sales return reported in the balance sheet is 85,000. This is the estimated sales return that the company expects to get back from the customer, but the customer has not returned yet. And this 85,000 is all related to year 2 sales. Okay, now note that the actual sales return that come back during the year will always be credited to the AR account. Okay, now you need to understand just one method, okay, and understand what does each figure represent. Like for example, what does the sales return allowance figure in the income statement represents.